Happy New Year. 2022, it sounds crazy to even say that. It's time for another Rogers Capital video where we attempt to be the antidote to water cooler wisdom. First, let's take a look back at 2021. There were many voices a year ago who said that the wrong side had won the election, especially after the two Senate seats in Georgia turned all the power over to the Democrat side. You had a lot of voices saying that it just wasn't even possible for markets to perform well, that politics would dominate, and it was going to be a rough year for investors. We had to talk quite a bit about profits drive markets instead of politics. And how'd the year turn out? Well, the Dow went from 30,000 to 36,000. International was another topic you heard a lot of voices about. International, you had to be in international. That's where the valuations are. With all that we have going on in the U.S., you just have to be there. That's the place to be. How'd that work out? So many voices telling us that, and it didn't work out too good. In fact, the last 6 of the months of the year were a punch in the face for international, especially China stuff. You heard about energy, about how the incoming administration was going to target the big energy and oil companies. And so, that'd be a disaster to look at. Green energy was how'd that work out? Well, energy stocks just happen to have the best year they have ever had on record. So 2021 was a pretty interesting year, and it was a pretty good year for stocks. 30% for the S&P. We had 70 new all-time highs, 70. How about pullbacks or corrections? We had one, 5.2% pullback. We had every quarter as a gain, consecutive 4 quarters. In fact, even back into the 3 quarters of the previous year, we strung together now 7 consecutive quarterly gains. But I'll come back to that here in a minute. Now, it wasn't all roses. I mentioned some of the international stuff, and really it was a tough year for bonds being down 1.7% last year. But let's take a look forward. How about 2022? Well, we just had a 10% fourth quarter. And I mentioned those 7 positive quarters in a row. That's happened before. In fact, it's happened 6 times. What happens in the 6 months and a year following real strong growth, 7 quarters of quarterly gains? Well, the market has never been lower 6 months later. 6 for 6. And the average return over that 6-month time frame is 8.5%. What about 1 year later? Well, only once have you been down a year later. The average over those 1-year time frames, though, is 14.1%, a trend to pay attention to. If the first quarter low stays above the December low, it tends to be a good year. In fact, only once have you been negative if that was the case, and that was 2015, where you barely even down 0.7%. The average returns for those years following are 18.4%. All that to say, really in several of these statistics, if the market's on strong fundamentals, on a strong footing early in the year, it tends to follow through. What about the Santa Claus rally? We can look at the 5 final trading days of the previous year and then the first 2 days of the incoming year. And if that trend is down, it usually signals, or certainly in the last 25 years, has signaled some pretty serious downturn. We remember 2000. 2008 was another example. 2016 was as well. Most remember 2000 and 2008 being tough years. But 2016 was actually the worst 6-week time frame to start a year of any on record. Late that year, after the 2016 election, we had a pretty solid boom in November and December of expectations and kind of pulled that year out of the ditch. But pretty serious downturns when that Santa Claus rally was negative in 2000 and 2008. Well, how'd we do this year? Well, we were slightly higher in the 5 last days of the year and the first 2 of this year. So something else to watch. Another thing you'll hear these days is, well, we had a great year, but we all know what happens when you have a great year, right? What goes up must come down. Well, not so fast. Don't fear the big years. In fact, in 25% plus years, we've had 15 of those. 13 of those 15, we've been better off the next year. We've been up the following year. And the average in those 15 is an 11.1% average. Big years aren't a reason to be bearish or afraid to run for the hills, but they are a reason to be cautious. Now, there's no reason to expect that we do 25, 30+% again. In fact, again, the 15 instances we've seen, never once have you done that again. What's probably in the cards is a return to normalcy, but also with some added volatility. In fact, if I could sum up my expectation for 2022 in one word, it would be this: volatility. With inflation, the Fed rate hikes that are coming, midterm elections. In fact, of the 4-year election cycle, the most volatile year is this year, year 2, midterms. Now, not the worst performance year, but the most volatile year. The average correction in midterm years is a 17% correction. Now, what is 17% in numbers? Well, on a 36,000 Dow, that's 6,120 points. That's the average correction. So we'll be watching that volatility and inflation and the Fed. I'm not pessimistic. I'm still cautiously optimistic. For another 6 months or a year, we should be able to continue to kind of ride this profit growth forward. But it'll be a very interesting year. These are the years that weed out the pretend investors. We'll talk to you next time.